Welcome to today's video session. My name is Mike Smith and we're going to revisit risk. Remember, risk is what we're trading. Risk is something we should embrace, but we should also manage it well. With one of the strategies that you'll often see us trade, when we are making decisions about which strategy we're using, we should upfront be absolutely crystal clear about the risks associated with a particular strategy. Now, just to take a step back and look at the different types of risk we consider. And really, we're trading two types of risk. There's the dollar risk if we sustain a risk event, i.e. the exit point is triggered. The second type of risk consideration is the chance of that risk event being triggered. In some strategies, the chance of that risk event being triggered is quite high, and hence you get rewarded for it by a greater potential return. In others, the chance of a risk event is relatively low. Now, for that, of course, we don't get the same reward and possibly even sustain a high dollar risk. With credit spreads, our idea is to take away the risk event from the current share price. So if we look at a chart here of General Motors, we've got a buy signal on the chart. We've got a clear line in the sand that says, well, look, current share price looks comfortable above this. So we may choose to put our credit spread below that 31 price point and have a 30-31 bull put spread. So what that means is if it finishes anywhere above 31, we're in our profit zone, we keep the premium brought in. So it's got to drop $1.31 before that risk event is triggered. So that's the concept. But understand, of course, we may bring 15 cents premium in and we keep that if it finishes above 31. However, with us having a 30-31 spread, our risk is $1 minus that 15 cents premium we brought in. So totaling 85 cents risks. So although the chance of that risk event being triggered is lower, if that risk event is triggered, unless we have a proactive way of exiting early, our dollar risk is significant. So that's what we look at with every strategy. So what does that mean for you in terms of taking the approach of reducing the chance of a risk event occurring? So taking on the additional dollar risk. When would we consider this strategy? Well, look, here's the bottom line. If there has been high market volatility, what that means is that option premiums are high. We can take that risk event away and generate a nice premium, even though the strike prices of the spread that we've bought are far away from the action. As volatility drops, there's a decreasing chance of a large price movement. And of course, associated with that, we've got the impact of time decay, which again decreases the chances of a large price movement away from where we are now. So this is the ideal setup for a credit spread. We've got a decrease in market volatility from high heading down towards low, and obviously we've got a short duration to take advantage of the positive impact of time decay on a credit spread. I trust that clarifies some of the issues around strategy choice. We'll see you again soon.